You've been told you need $1 million to retire early, but you're juggling a 9 to 5 family and bills. Here's the thing: 4 ETFs, one simple plan, and automation can get you compounding while you work. Today I'll show you exactly why picking stocks holds you back, why ETFs win for beginners, and the first ETF that pulls the whole portfolio forward. If you want a plan you can set up in one afternoon and trust for years, stay with me. Most beginners think the game is finding the next Tesla early. That's not investing. That's trying to be a fortune teller under time pressure. Picking individual stocks demands research, accounting chops, and a stomach for concentrated risk. Miss one earnings landmine or buy into a hype cycle late, and you can lose years of progress. Years. Here's the thing most people miss. You don't need to be right about companies. You need to be right about trends, disciplines, and time. ETFs win because they spread your risk across dozens or hundreds of companies, while still letting you tilt toward the parts of the economy that actually drive returns. Instead of guessing which CEO will execute, you own the whole category that benefits when the world spends money in a certain direction. You get broad exposure, instant diversification, and lower costs than most managed funds. That means fewer unforced errors and more time for compounding to work. There's also a psychological edge. With single stocks, every headline can feel like a personal emergency. With ETFs, bad news in one company gets cushioned by the rest. That keeps you calm and invested, which quietly becomes your competitive advantage. The market rewards consistency far more than occasional brilliance. And because you're working a 9 to 5, you need a plan that runs in the background. ETFs let you automate contributions, keep fees low, and rebalance with simple rules instead of gut feelings. Pros burn out chasing alpha. You'll win by avoiding the common mistakes: overtrading, concentration, and panic selling. If you remember nothing else, remember this: markets are engines built on human behavior. Most investors sabotage themselves with impulse ETFs. Replace impulse with structure. Structure keeps you invested. Staying invested is where the math gets good. Once you accept that, you can build a portfolio that does the heavy lifting while you live your life. Which brings us to the first piece of the engine. Semiconductors are the picks and shovels of the modern economy. Every smartphone, car, cloud server, and AI model consumes chips. When demand for chips rises, it's usually because the world is about to spend on new devices, data centers, automation, and software. That's why chips tend to lead growth cycles. SMH, the VanEck Semiconductor ETF, packages the key players, so you're not betting on a single winner in a brutally competitive industry. Why does this matter for your 9 to 5 portfolio? Because you need a growth engine that captures big secular trends without forcing you to guess which company nails the next hype on the internet. SMH holds a concentrated basket of chip designers and manufacturers that sit at the choke points of global tech. Designers that architect the brains, equipment makers that supply the factories, and foundries that print the silicon. When the world upgrades, these firms touch the cash flow. Here's the shortcut nobody teaches beginners. Chips are upstream of almost everything cool. AI needs GPUs, cloud needs CPUs and accelerators. Cars need more silicon every model year. Even boring industrials are adding sensors and control systems. When those budgets unlock, chip revenue moves first, software later. That leading behavior is what gives SMH the potential to pull your portfolio during expansions. What's the catch? Well, it's one big cycle. Orders surge, then inventories build, then come the headlines about a downturn. This is where most people mess up. They buy late in the hype, panic on the first inventory correction, and sell right before the cycle turns back up. Your job isn't to outsmart the cycle. Your job is to own the category through cycles, with rules that keep you from flinching. Practically, that means sizing SMH as a growth sleeve, not your entire portfolio. Think of it as the accelerator, not the whole engine. Use automatic monthly buys so you pick up shares during the dull, scary moments when prices are better. Set a simple rebalance range, so if SMH runs hot and becomes too large, you trim back to target and lock in gains without guessing tops. If it lags and drifts underweight, you add back to target. No heroics, just discipline. Common mistakes to avoid: chasing headlines. By the time a new chip cycle makes front page news, much of the move has happened. Concentrating in one darling stock. The winners rotate. Let the ETF handle that rotation. Trying to time macro. You'll be late both ways. Your edge is systematic participation. Let me show you exactly how a beginner can apply this today. Suppose your overall plan uses 4 ETFs, and you allocate 30% to SMH as the growth engine. You turn on automatic buys from every paycheck. You set a 5 percentage point drift rule. If SMH grows past 35% of the portfolio, you trim back to 30%. If it falls below 25%, you add back to 30%. That's it! No charts, no predictions. The rules handle the cycle so you don't have to. Why this works: semiconductors have long-term demand drivers, AI, cloud, edge computing, automotive electrification, that are bigger than any one quarter's inventory hiccup. But the path is noisy. Your rules turn that noise into opportunity by systematically buying weakness and trimming strength. Over years, that converts volatility into shares and realized gains. The thing most people miss is capacity. Chip supply is lumpy. New fabs take years. When demand surprises to the upside, pricing and margins expand quickly. ETFs like SMH capture that inflection without you needing to know which node, which supplier, or which customer will catalyze it. You just need to own the ecosystem. 2 quick guardrails. First, understand risk. SMH is more volatile than broad market funds. That's fine, as long as it's a sleeve within a diversified plan. Second, tax placement. If you're buying and rebalancing regularly, prioritize holding tax-inefficient pieces in tax-advantaged accounts when possible to reduce drag. Keep it simple. Growth ETF in a tax-sheltered account, if you can. If not, minimize unnecessary sells. If you remember nothing else from this section, remember this. Semiconductors are the economy's early tell. Own them through cycles with rules, and they'll pull your portfolio when growth returns. Don't chase, don't time, and don't concentrate. Automate, allocate, and let the engine run while you focus on your 9 to 5. Now that you got a growth accelerator, you need a counterweight that steadies the ride. That's XLV, the Healthcare Select Sector SPDR. Think of XLV as the portfolio's shock absorber. People get sick in recessions and booms. They fill prescriptions, see doctors, and use insurance regardless of headlines. That steady demand shows up as more stable earnings, softer drawdowns, and a smoother line that helps you stay invested. Why this matters for a 9 to 5 investor: your biggest risk isn't picking the wrong fund, it's bailing out at the wrong time. Healthcare helps prevent that. XLV bundles big pharma, medical devices, managed care, and biotech into one diversified slice. You're not betting on a single drug trial or a moonshot. You're owning the system that delivers care in the real world year after year. Here's the thing most people miss. Defense doesn't mean dead money. Healthcare has multiple growth drivers that don't depend on the business cycle. Aging populations use more care. Chronic conditions require ongoing treatments. Medical technology keeps improving, from robotic surgery to diagnostics to wearables. Managed care firms negotiate, price, and process that river of demand. You get durable cash flows, plus innovation, in the same wrapper. And what does XLV do in your plan? It balances the emotional load. When your growth sleeves are zipping around, XLV often moves less. That lower volatility makes your overall chart easier to look at, which makes the plan easier to stick with. And once you stick, compounding does the heavy lifting. That's the psychology edge we want. How to implement it. In a 4 ETF mix, target 20% to healthcare as your defensive sleeve. Turn on auto buys from each paycheck. Use the same simple drift rule you've been hearing. If XLV climbs above 25% of your portfolio, trim back to 20%. If it slips under 15%, add back to 20%. No predictions. Just rules that buy when it's quieter and trim when it runs. Let me show you exactly how that plays out. Say a market scare hits tech, and your growth sleeves wobble. XLV usually falls less, so your allocations drift. Your rule will send new dollars toward the beaten down growth while occasionally shaving XLV if it gets too heavy. That's buying low and selling high without staring at charts. It's mechanical discipline, not heroics. If you remember nothing else, remember this. XLV's job is not to win headlines. Its job is to keep you comfortable enough to keep going. When you combine a growth engine, a growth core, and a healthcare counterweight, you get a portfolio that pulls in expansions and steadies in slowdowns. That balance is what lets you focus on your career while your plan compounds in the background. Now that the semiconductor sleeve is your accelerator, you need a core growth seatbelt. That's QQQT. Think of this as broad tech-led innovation. Without having to guess which theme wins next, you're getting the biggest, most profitable names pushing software, cloud, AI, and consumer platforms, plus the discipline of rules baked into your plan. Why this matters for a 9 to 5 investor? You want enough upside to feel the compounding, but you can't babysit a watch list. QQQ covers the NASDAQ 100, large established companies with real cash flow. QQQT is a variant that aims to smooth the ride by adding an options overlay for income and drawdown control. Translation: QQQ is pure growth beta. QQQT trades some upside for steadier cash and smaller dips. Pick the one that fits your stomach. Here's the shortcut most people miss. You don't need to predict which AI model wins or which cloud vendor takes share. You need to own the platform layer that captures spending across those battles. QQQ does that. By holding a basket where winners rise in weight and laggards quietly fall, it's self-pruning. That's a built-in discipline beginners can lean on. Stakes first. Do this wrong, by stock picking the hottest name or by going all in after a rally, and you end up buying high, panicking low, and repeating it for years. Do it right, steady buys into a diversified growth core, and you harness tech's long runways without turning your portfolio into a casino. Your career funds the contributions, the core fund compounds them. What to do? Set a target weight for QQQ or QQQT as the backbone of your equity. For a 4 ETF plan, 40% in the growth core is a clean starting point. Automate contributions every paycheck. Use your drift guardrail. If your growth core climbs above 45%, trim back to 40%. If it sinks below 35%, add back to 40%. No feelings. The rule decides. Which one should you choose? If you're comfortable with bigger swings and want maximum participation in bull runs, QQQ is simple and effective. If market drops make you lose sleep and you like a steadier income stream, QQQT's overlay can help you stay put. The best choice is the one that keeps you invested through rough patches. Staying invested beats optimizing on paper. Let me show you how this plays in real life. Say you're contributing $500 per paycheck. $200 goes to QQQT automatically. If markets slump and your core slides to 35% of your portfolio, your auto buys top it up faster. That's buying at better prices without trying to time bottoms. When the rebound hits, your share count is higher. That's the quiet math. Why this works? The largest innovators benefit from network effects, distribution, and balance sheets. They can invest through downturns and take share when weaker players retreat. By owning the basket, you capture that survival advantage without guessing who wins, and your drift rule turns volatility into a rebalancing bonus. Quick sanity checks. If you love the idea of QQQ but know you'll flinch during a 30% drawdown, choose QQQT and stick to the plan. If you're fine with volatility and want the full upside, choose QQQ and let it run. You can also split them, 20% QQQ, 20% QQQT, to blend the ride. If you remember nothing else, remember this. The core's job is to keep you compounding in the economy's growth engine year after year. Automate the buys, respect the drift bands, and let the giants do the heavy lifting while you handle your 9 to 5. Now that you've got an accelerator, a core, and a counterweight, here's the focus tilt that keeps you plugged into the AI wave without turning your portfolio into a science project. AIQ, the Global X Artificial Intelligence and Technology ETF, is a rules-based basket of companies building or benefiting from AI chips, cloud infrastructure, data platforms, and applied software. The key word is tilt. This is not a casino bet. It's a targeted slice that adds exposure to a secular trend already shaping earnings. Why this matters for a 9 to 5 investor? AI will show up in your returns whether you pick stocks or not. The question is how to capture it without chasing headlines. AIQ screens for companies tied to machine learning, natural language processing, and big data, and it rebalances for you. That means you get exposure to the ecosystem, hardware, plumbing, platforms, and applications, without guessing which startup wins or which buzzword fades. How to implement it. In a 4 ETF plan, target 10% to AIQ as your trend tilt. Turn on automatic buys from every paycheck. Use the same drift guardrail you already know. If AIQ climbs above 15% of your total portfolio, trim back to 10%. If it slips under 5%, add back to 10%. No feelings, no FOMO. The rule determines the move. A quick example. Suppose AI infrastructure gets a surge of corporate spending and AIQ jumps. Your allocation drifts over 15%. You trim the excess and send those gains back into your core or healthcare sleeve. If AI excitement cools and AIQ drifts to 7%, new dollars top it back up. You're effectively selling some strength and buying some weakness on autopilot. That's how you convert storytelling into math. Common mistakes to avoid: overlapping tilts. If your SMH and QQQ already hold a lot of AI leaders, AIQ is a complement, not a replacement. Keep the position modest. Narrative chasing, product demos don't equal durable profits. Let the index methodology add and remove names. One-off timing trades. You're not trying to catch a single headline spike. You're tracking a decade-long adoption curve. Taxes and accounts. If you can, hold the AI tilt in a tax-advantaged account to reduce drag when you rebalance. If you're in a taxable account, prioritize adding overselling when near your bands, and set contributions to do most of the rebalancing for you. Why this works? AI is not one company or one chip. It's an upgrade cycle across compute, data, and software that compounds through productivity. A diversified tilt catches more of that curve and lowers the risk of being wrong on any single name. The rule-based approach keeps you steady when narratives whipsaw. If you remember nothing else, remember this. AIQ is the focused lens that keeps you in the AI trend without letting hype hijack your plan. It's exposure with discipline, inside a portfolio already built to compound. You don't need a second job managing this. Here's a simple 20-minute weekly routine that keeps the plan tight and your brain calm. Minute 1, check contributions. Make sure auto buys hit all 4 ETFs according to your targets. If you got a raise, bump your contribution rate by 1% today. Tiny nudges add up. Minutes 2 to 6, glance at weights. Are any sleeves outside the 5 percentage point bands? If not, you're done with allocation. Don't invent work. If yes, note which one needs attention. Minutes 7 to 12, rebalance with new money first. In tax-advantaged accounts, send the next contribution toward the most underweight fund. In taxable accounts, direct dividends and fresh cash to underweight sleeves. Only sell if a sleeve is clearly over the band and new money won't fix it soon. Minutes 13 to 16. Tax hygiene. Confirm your highest turnover sleeves, SMH, AIQ, QQQT, sit inside 401k/IRA. In taxable accounts, verify dividend reinvestment is off if you're using cash dividends to rebalance. That's how you trim taxes without thinking about it again. Minutes 17 to 18. Sanity check. Any life changes? New job, bonus, or cash need coming up? If yes, adjust contribution amounts. Don't touch allocations unless your risk tolerance changed. Minutes 19 to 20. Close the app. Seriously. No headline trading, no quick ideas, no new ETFs. Your edge is consistency. Here's a monthly add-on to your checklist, only 5 minutes. Review your paycheck date alignment so contributions hit all through the month, not all at once. Also quarterly, contribute one extra check, only if a sleeve breached a band and stayed there. Do a small one-time rebalance inside tax-advantaged accounts. That's it. The routine is boring by design, so the results aren't. If you want the exact setup, broker settings, auto buys, tax placement, and a printable checklist, watch the next video I linked. This is the Money Introduction channel. No question is a stupid question. Drop yours in the comments and I'll make a video about it. Subscribe for pragmatic strategies that build real walking away money. Set it up today and let compounding run.